as we look at these numbers coming in line with estimates. So pretty much the trajectory, I suppose, that we have been seeing, and one that the Fed would like. I'm sort of putting aside the year-over-year numbers now and focusing on these month-over-month ones.
Yeah, I think, well, first off, thanks for having me on. And I think that's absolutely right. This is just a continuation of what we saw last month, that we're seeing softer inflation trends. We're starting to really see firmer signs of moderation on the inflation front. And you're seeing it be more broad-based. Yes, you did have that big drop in used cars. It was a little smaller than what we were looking for, and we think we'll get some more in the months to come. And that's going to put downward pressure on future readings. But I think you guys did an excellent job describing the data and walking through it and just pointing out how broad this was. You know, you saw those drops elsewhere. You saw drops on the services side. Shelter is obviously the sticky component, but we know that's coming down because asking rent inflation has been moderating for some time. And that will eventually catch up and show up in the CPI data. So again, this is another continuation that we're moving along the right path when it comes to inflation right now.
So, Victoria, does the Fed do anything with this report?
No, I think this aligns with what the Fed was expecting. I mean, we saw the numbers pretty much match what expectations were. I am a little surprised in the fact that we didn't see the headline number go a little bit higher than what there was. I mean, you look at oil. Oil is up 20% from the middle of June till now. So I think it's just been buffered maybe by some of the other declines. You mentioned auto prices going down. And I think the base effects that we're seeing are actually being a very positive effect on CPI right now from a year ago, whereas without being the higher numbers that we were then, we might have a different story right now. Obviously, core is the area of focus for the Fed. They know that it's going to be sticky when it comes to rents. I actually was listening to a number this morning that New York rents are the highest that they've been, I think, in 10 years. So there's going to be some stickiness that stays there. But I think all in all, the Fed probably sees this as fitting into their narrative.
Stephen, one of the things that some folks have talked about is that while we are getting this disinflationary trend now, we could see a little bit of an uptick before the end of the year. Do you expect that to happen? Maybe propelled by one of the things Victoria was just touching on, the fact that oil prices have come back up, but that takes a little while to sort of filter through to everything else.
Absolutely. So to Victoria's point, we're looking for, in the next report, for a much larger energy increase, given the rise in gasoline prices, given the increase in crude, and also in natural gas. And then you have some upside risk factors around food inflation as well. Of course, we're in the midst of pretty serious drought that can eventually spill into higher food prices. Probably not in the near term, but maybe further out into next year. Then you have El Nino to think about as well. That's another kind of risk factor for food prices. But those are non-core components. So that's something the Fed may look through for the time being when they're judging where's the underlying trend in inflation. And that's where they'll look for core inflation. And right now, the news, I would say, is broadly positive. On core inflation, I would say you may get a little bit of an uptick in CPI, but that's more of a methodology quirk when it comes to health insurance. And that should kick in the fourth quarter. Health insurance has been a big drag on CPI for the last 10 months or so. And then it will start to be a bit of a positive contributor turning in 4Q, just given the way BLS calculates it for CPI. The good news there for the Fed and how they look at the data is that they focus on core PCE inflation or PC inflation, and that isn't subject to the same methodological quirks that core CPI and CPI inflation is when it comes to health insurance.
Victoria, let's perhaps take this conversation to people's portfolios as well. Mm-hmm. If you're reading this report this morning, you're sitting at home, you've got the Yahoo Finance platform loaded up, and you're taking a look at your own portfolio, your watch list, and trying to figure out, is there any trade that I initiate off of this that's different from the strategy that I'd already set in place coming into this report, knowing what the Fed has already said, knowing the trend that you were mentioning that's already in place? Is there any massive kind of repositioning that you make, or is it still kind of the same strategy that many people have employed?
I think you're going to hold on to the strategy that you've had. And I don't think there's anything in this report that is going to take someone, whether they were more bullish or more bearish on the economy, and change their opinion. I think it's since it is so in line, and since we know that going through the rest of this year, we could actually see an uptick in inflation. I think if you were conservative, you're going to stay conservative. So we've been having a balanced portfolio, right? We like a little bit of value. Value value actually outperformed growth over the last few days. So we like a little value in the portfolio, but you want some cyclicality because there is some positive news in the economy, right? We're looking at GDP. I mean, Atlanta Fed is saying, 4% for this quarter, which seems a little excessive. Maybe that comes down some, but there's still some positive news there, but we still think we should be cautious. It's going to be quite choppy. We've come down a couple percentage points from the high. I wouldn't be surprised if we come down a little bit more and you get the S&P somewhere maybe consolidating around a 4,300 level. At that point, I think if you want to start making a shift, you can do that. But for now, keep that balanced portfolio in order to kind of ride through the choppiness that we expect.
Stephen, we talked to one of your colleagues, Aditya Bave, last week about the fact that Bank of America no longer has this recession call. Like many, we're seeing a lot of other research shops kind of pull back on that. And so, this seems to be sort of in line with what people have been looking for. What then is the biggest risk here going forward? Is it that if we see inflation tick up before the end of the year, the Fed gets more aggressive again? What risks are you watching for?
Yeah, I mean, that's definitely a risk. I mean, the Fed has to take this risk management approach to begin with. So if they're seeing inflation kind of come down on its own, this immaculate disinflation story, we're not seeing really pain in the labor market, you don't get that recession scenario, then how do they guard against that? Well, what we think they'll do is basically they'll be more gradual in their cutting cycle. They'll cut a little slower. They'll ensure that they're going to stay in restrictive territory for longer and put downward pressure on the U.S. economy because they want to make sure inflation doesn't reaccelerate. It could definitely happen. We've been head faked before. We think this is not a head fake right now. What we're seeing is actually, what we've been expecting for some time is just finally coming to fruition, where you're seeing broad-based deflation in goods because you've seen improvement in supply chains. That shelter, that biggest component of the core CPI basket, is going to continue to gradually moderate. So that's, kind of baked into the pie, but you have to be a little bit worried that, the resiliency of the consumer can make that descent of inflation, that path towards 2%, that path towards the Fed's 2% target, take a little bit longer. And what that means is that the Fed, absent kind of a downturn in economic activity, well, they're going to be cautious. They don't want to repeat the same mistakes of the 70s, of the 80s. They don't want to force kind of a double dip recession. And they don't want to push the economy necessarily just into a recession if they don't have to. So that's where it really becomes difficult to really fine tune policy in the years ahead.
Stephen, that's pretty interesting because we've continued to hear even more about the either likelihood or possibility, as you put it, that inflation could spike or move higher once again, even though we've seen the larger trends start to lock in here. What is the likelihood that you would put on that and say that, sure, some of the signs point to a soft landing right now, but if we do see another spike of inflation, what that would mean for our entire kind of plain landing scenario and analogy that we've kind of just been flying on for a while?
Right. Well, I think when it comes to the Fed, most landings are bumpy, rather than smooth. We've had a few soft landings, 95 probably being the best example. There's a few more in history. We think they're on the right trajectory right now, but you have to be a little bit careful as things progress. The upside risk to inflation probably is just the fact that the labor market is still tight. You still have wage inflation growing at, say, 4 to 5%, depending on what measure you look at. That's more in line with price inflation of around 3 to 3.5% based on what productivity is growing at right now. So that would mean that, yes, we've seen basically that progress kind of towards 3% inflation, towards sub 4% inflation, but getting it all the way down to 2%, that could take a lot more work. And that's where the Fed will probably lean on being restrictive, staying higher for longer, and really just putting that downward pressure on the economy. But that upside risk to inflation, it all boils down to kind of the labor market and wages. If we remain tight for longer, if we remain as tight as we are in the labor market, then you could definitely see some reacceleration in wage inflation. You saw that a bit in the average hourly earnings data recently. Obviously, you've had the UPS negotiations. You potentially have the United Auto Workers negotiations coming up later this year. So there are signs that maybe, you could have wage growth kind of pick up a little bit, and that would put upside risk on the inflation trajectory from a fundamental standpoint.
Speaking of upside pressure here, we have, of course, seen bond yields move up as of late, above 4%. It looks like they're holding above, they're kind of vacillating, but they're might be holding above 4% in the wake of this report. Victoria, how problematic is 4% plus 10-year yields for U.S. stocks?
Yeah, the plus part is what's going to be concerning. So it looks like the economy can take, or the equity markets can take, a 4% yield. We're seeing that right now. We've seen the yields move up for a variety of reasons, though, and I think that's part of the reason the economy is somewhat taking this in stride. Obviously, you have a more of a soft landing scenario for a lot of people out there. Inflation has been pushed off further. So those are elements that are making it go a little bit higher. We've had the Japanese yield curve. We had the Fitch downgrade. There's different things that have kind of led to have some higher yields here. But the equity market needs stable bond yields if it wants to continue and have a sustainable move higher. And I don't think we're at calm bond yields at this point in time. I don't think the Fed is done. I don't think they're ready to call the all clear because of the wages and the things that we're just speaking about, potential for CPI to go, and they don't want to take their foot off the gas too soon, right? The double dip recession that we're talking about is a very thing that could happen. And so they want to make sure that they avoid that. I would not be surprised to see another 25 or 50 basis point hike, which means yields could go a little bit higher. That pressure above 4% is going to keep the volatility in the equity market. It goes back to that whole narrative of a very choppy second half of this year.
Great to have you both here with us this morning, breaking down all things CPI plus.